So thank you so much for coming. My name is Lisa Whittleton, and I'm a financial advisor with True Life Insurance and Estate Solutions. So I'm going to cover 3 different topics today, and I'm going to try and get through them as quickly as possible and answer some of the most frequent questions that I get. So I just wanted to have a, excuse me, I'm fighting a bit of a cold here, so I'm going to grab some water just in case. So just a quick show of hands. How many people have already been approved for the disability tax credit? Quite a few. Okay, so I'm going to just skip this part of it. If you have not ever heard of the disability tax credit, then certainly get in touch with me and I'd be happy to give you a primer, but this is the easier part of the presentation. So actually, I will mention one thing. This is new. So if an individual is not, so most of you, I'm not sure if you're aware, a lot of people when they get approved assume that they're going to be approved for life. So the person with a disability is going to be approved for life, and that is not typically the case. It doesn't matter whether the condition is a lifelong condition or not. I have a client who has a 2-year-old child with Down syndrome, and CRA approved her for 2 years. So it has absolutely nothing to do with the disability itself. It's how the individual at CRA felt when they were approving the form. So this is in relation to disability savings plans, and previously, if an individual lost their approval for the disability tax credit, then the disability savings plan would have to be shut down entirely, and all of the government grants would go back to the government. This was a big barrier to a lot of people. They said, you know, I have to reapply in 2 years, I don't know what's going to happen. It's too much of a headache for me to open a plan and then have to close it in 2 years if we don't get approved. So they've held off on doing it. So in the federal budget this year, it was announced, this is like the best news that's happened in a really long time with respect to disability tax credits and registered disability savings plans. But effective immediately, so even if you have an RDSP open today and your disability tax credit is potentially coming up for renewal, effective immediately, an RDSP can remain open even if your disability tax credit is expired. So it just means that no contributions can be made. You're not opening up any new grant or bond entitlements. You are allowed to do withdrawals with a modified repayment rule, and you can recontribute if you are approved for the disability tax credit in the future. So that's just a little bit of something new that came out of the budget this year. So the registered disability savings plan. So of those of you who are approved for the disability tax credit, how many of you have a registered disability savings plan? Okay, so not as many, but quite a few still. That's pretty good. So the registered disability savings plan is basically it's a savings plan similar to a registered retirement savings plan or a tax-free savings account or an education savings plan, and it's a government program that allows for you to contribute as well as the government. There are some benefits of the actual disability savings plan in and of itself that's different from the rest of them. So in order to qualify to open an RDSP, the person with the disability must be approved for the disability tax credit. They must be less than 60 years of age, be a Canadian resident, have a valid social insurance number, and have completed 2 previous years of income tax filings.
I don't believe that last item was not relevant when I opened the RDSP.
Even you can still open it, you won't receive any grants or bonds because they're income dependent. So if you haven't completed any tax returns, there's no income tax that you can attribute it to. And so the value of the actual RDSP kind of goes out the window if you aren't receiving those grants and bonds.
So even if they're under 18?
If it's under 18, it's the parent's income. So the parents would have had to file the income taxes for the previous 2 years. Yeah.
It's worth it.
Can a person who is not mentally competent get a social insurance number and file tax returns?
Yes, absolutely. And they should, because a lot of the benefits, provincial, municipal, provincial, federal, are based on income. And as soon as the individual turns 18, it is not dependent on contractual competency at all.
What about as a minor, though?
Yep, absolutely.
As well?
Yep.
Okay.
So I'm just going to hold off on the questions till I get to the end of the RDSP portion, and then if I haven't covered anything, then you can either feel free to ask or meet with me at the end. Oops, sorry. So why would somebody open an RDSP? The best thing about it is truly the most lucrative savings plan you can have in the entire world. There's no doubt about it. The government grants and bonds that are available are $90,000 from the federal government, which allows for less personal contribution from yourself as well as accelerated growth of your savings. It also provides financial security, peace of mind for other family members. So again, if we're looking at a situation where there's siblings involved, for example, we don't want a sibling to feel compelled to financially be responsible for their sibling. And so a lot of times this gives peace of mind for other family members. There's no impact on any other federal or provincial assistance benefits, asset or income. So we'll talk about that a little bit more later. And there's no restriction on how the money is used when it's withdrawn. So that's also quite a valuable piece on the RDSP. So how do you put money into an RDSP? So now you've got the disability tax credit, you're qualified, and how do you put money in? So contributions can be made by anybody with the permission of the account holder. So whether it's a grandparent, a friend, you're doing a GoFundMe campaign, whatever, money can be put in by anybody. So even if the person with a disability doesn't have any money themselves to put in, somebody else certainly can contribute on their behalf. Contributions can be made until the beneficiary reaches age 59. You can also have tax-deferred rollovers. So this is more of an estate planning tool, but you can have, if a parent or a grandparent of a dependent child passes away and they've got an RDSP open, you can actually use a rollover mechanism to actually save on the estate taxes. So RRSPs, RIF money, RPPs, these are all different kinds of pensions. Or if you have an education savings plan, it can also be rolled in. And there's a maximum lifetime contribution limit of $200,000. So that does not include the government grants and bonds. That's a personal contribution alone. And a lot of people will say to me, like, that's insane. I could never put that much money in. There's no minimum that's required to open it. And again, on the estate planning side of things, we can use the RDSP and that high minimum to be able to, again, shelter money from an ODSP standpoint and potentially spread out how the assets are set up in the will without having to dump everything in a Henson Trust, which again has different rules than the RDSP. So the grants and bonds, again, this is the most lucrative part about this plan. And if you are qualified for the disability tax credit and your loved one with a disability qualifies for one, there's absolutely no reason that I have encountered yet that you should not have one. If the individual is on ODSP and they don't have money, the bond side of things are completely dependent on income. If they're a low-income individual, just opening a plan, the government will put in money if they have nothing to contribute. So there really is no downside to this. So again, the grants and bonds are based on net family income. So if the person with a disability is a minor, then it's dependent on their parents' net income. So that's after taxes, after any deductions. If it's a child who is still living with you but is an adult, it will then be dependent on the adult-dependent child's income. If you've been approved for the disability tax credit, but you've been holding off on opening a disability savings plan, one of the great things is that you can retroactively collect on those grants and bonds for up to 10 years. And the grants and bonds are available until age 49. So the Canada Disability Savings Grant is actually where you put money in and the government will also contribute. So you can get up to $3 in government grants for every dollar that's contributed. So what that translates to is you put in $1, they put in $3, that's a 300% rate of return on your investment immediately before any sort of growth happens. Most of us, if we could take advantage of something like that, would jump on it. So there's a maximum lifetime grant limit of $70,000. And on the Canada Disability Savings Bond, again, this is where no contribution is necessary. So you can get up to $1,000 a year to a maximum of $20,000, even if you have nothing to contribute. And this is for low-income individuals to be able to have a savings plan. So this is a pretty powerful slide. It talks about the carry forward provision, again, going back 10 years. So unused grant and bond entitlements can be carried forward. And there's an annual maximum of $10,500 in grant money and $11,000 in bond money that you can collect if you're going retroactively. So for example, Jane has been approved for the disability tax credit since birth, but only opened her RDSP in 2019. She has been on ODSP her entire adult life, which means that she's a low-income individual. So we open a plan for her in 2019. And often what I encounter is that a lot of people have money put aside for the person with a disability. It's just not in a disability savings plan. So if you've got money elsewhere, and again, if it's an education savings plan that you don't think can be used, tax-free savings accounts, whatever the case may be, But if you're able to maximum fund it every year to get the maximum allowable grant, that means that a $3,500 contribution in 2019 will net you $10,500 in grant and $11,000 in bond money. So on your $3,500 contribution. So that's even more than 3 times if you can't count the bond money. Again, in 2020, 21, 22, 23, you're still reaching back and getting those retroactive grants. So at the end of 5 years, you'll have contributed $21,500. You'll have received $50,500 in grant money and $15,000 in bond money. So you're looking at over $87,000 in less than 5 years. So there's, again, nothing that will grow at this kind of speed. So we've talked about how to open it, how to put money in. Taking money out. There's 2 different ways of taking money out of a disability savings plan. The first is a lifetime disability assistance payment. So any of you who have RRSPs and you're contributing to them, when you retire, you're going to be taking that out in what's called a RIF, so Retirement Income Fund. Very similarly, a disability assistance payment is basically something that you start at some point, and that's going to continue until age 83. So it's an income stream that can begin at any age, but it cannot, in the RDSP, it's legislated that it has to start no later than December 31st of the year in which the beneficiary turns age 60. The calculation that the government uses to determine what that individual is going to receive on an annual basis is a calculation that makes that money last until age 83. And once they've begun the income stream, they must continue either until the funds are completely depleted or the person passes away. So one of the questions I get, one of the biggest myths I hear is that you have to be age 60 in order to access the money. That is simply not the case. There are a lot of people with disabilities who have a shortened lifespan, and as a result of that, we may have to do some strategic planning, and we are able to access that money sooner. So one of the examples I can use is that there's a child who, is diagnosed with a condition at a young age. The parents aren't quite sure whether or not they're going to be able to go to post-secondary. But of course, because the disability savings plan is more lucrative, they would rather put money there than an education savings plan. So what we can do is we can open the plan and fund it. And when the child turns 8 or 9, what we would do is request the government to stop contributing their portion. And from there, you have a 10-year clock, and I'll talk about the 10-year rule. But you have a 10-year clock that starts, and at age 19, that money is accessible. The second kind of payment that you can get is what's called the disability assistance payment. So these are lump sum withdrawals. These can be requested at any time, and the withdrawals are, disability assistance payments can be requested at any time. It's a lump sum. And either one of these are always going to be made up of a portion of your own contribution, interest earned on the account, and grants and bonds. And the reason for that is simply from a taxation purpose. If you were to just withdraw your contributions, there would be no tax implications, and so they want to make sure that that's relatively spread out. That being said, most people, I shouldn't say most people, but there are people, a large number of people who are recipients of RDSP withdrawals that are not going to have a very high income, and so the tax burden is not going to be that great. Even if the individual has, for example, a physical disability and they're making $1 million in salary and they do have to pay tax on it, it will never be more than what they've received from the government. So it's still going to be beneficial. And then again, there's no restriction on how that money is used. So the proportional repayment rule is just a fancy way of calling it the 10-year rule. So a lot of people, again, get hung up on this 10-year rule and they really don't quite understand how it works. So what it means is that if money is withdrawn within the last 10 years from the last grant or bond deposit from the government, then the account holder must repay the lesser of one of two. So either $3 for every dollar that's withdrawn, or all grants and bonds that have been paid in for the last 10 years. This does not mean that it's a rolling 10 years. So again, that does not mean that money that you've contributed and grant and bond money that you've received from the government is now available in year 12, if you've been continuing to put money in between years 2 and 12. What it means is you've literally got a stopping period. So we've now stopped, let's say year 15. We've stopped the contributions. The government has also stopped putting grants and bonds in, and then the 10-year clock starts. So if you have somebody who they may have a shortened lifespan, and we want to be able to use those funds at age 40 with no penalty, we would then request that the government stop contributing grants and bonds at age 30, the clock starts, and at age 40 you can take it out without any penalty. There we go.
That kind of requires somebody to have a crystal ball, doesn't it? In terms of the person's development and...
Well, so what I use is basically statistics. I just Google the statistics on a particular condition. I try and find out what the average person, historically has lived, and we try and determine it based on that. So, in the event of death of the beneficiary, the RDSP will be closed, so it has to be closed down. There's no sort of rollover provision to a spouse or anything like that. It does have to be closed down. The proportionate repayment rule, so that 10-year rule still applies. And then the net proceeds go to the estate of the beneficiary. So if the beneficiary has a will, it will be dispersed as per the will, and if not, it will go through the regular provincial rules. If the 10 years have elapsed, then the grant and bond money that was in the account will also go to the estate. And then again, tax on proceeds included in the final tax return of the beneficiary.
Lisa,
Yep.
I don't, maybe everybody knows this answer, but I don't. But the definition of disability for these programs, because some of them are federal, provincial, what is it? Is it the same as ODSP, which is provincial?
No, so because the RDSP requires that you're approved for the disability tax credit, to qualify for the disability tax credit, CRA deems a disability to be something that's going to last for more than a year and is going to impact one or more of your daily activities of living. So there requires to be no diagnosis at all. You don't have to have a concrete diagnosis, provided that the condition that they have impacts one of their daily activities of living. So these can be walking, seeing, speaking, hearing, eating, going to the bathroom, walking, or mental functions for everyday life. So I always use the example of if a physician, for example, fills out an application and talks about how a child's disability impacts them at school, CRA will look at that and say, school is not a daily activity of living, so this person is not approved. It has absolutely nothing to do with the diagnosis. So even the person who's filling in the application for the disability tax credit, if they're not aware of what they're doing, it can be a little bit of the blind leading the blind, pardon the expression, but it really is something that unfortunately CRA has told medical professionals that they're required to fill this form out with virtually no direction to them. So it's a little bit difficult.
Doctor's letter?
They do, yeah.
They have to.
It's the doctor fills out the second portion, correct.
Are there guidelines for the doctor?
Very, very basic, and every medical professional that I ever meet, I always talk to them and say, what do you think about this? Do you fill them out? What is your opinion? My previous family doctor basically said she doesn't go to school to fill out forms. Fantastic. My eye doctor, I have vision problems, so I see a specialist, and he basically said, I fill them out, but I'm very uncomfortable because there's a lot of people that I feel would qualify, but they do not fit the criteria that CRA has laid out. And he said, but I don't think CRA knows what a peripheral vision loss, how that's going to impact somebody. They can't drive, they potentially can't work. And so he fills it out, again, based on how he feels, whether or not that person's life is impacted. And then I've had physiotherapists and oh my goodness. OTs, yes. Occupational therapists tell me that they've filled them out and often get them rejected. And again, physiotherapists and occupational therapists can only qualify for certain daily activities of living. So physio can only speak to walking. So if they speak to anything else, again, that application is going to be denied. I've seen an application that simply was incomplete. So the doctor didn't check off where they were supposed to check off no, and it came back not approved. And unfortunately, CRA doesn't give a lot of reason as to why you haven't been approved. And so people think, well, I filled my portion out, my physician filled out the other portion, and we all thought they would qualify, and we have no idea why they didn't. And it could be something as simple as an administrative thing. So it's a bit unfortunate, but we're working on it.
Are there any consultants?
There are.
Can provide guidance to?
There are. So I work with a tax professional who does help with that. There are what's called promoter companies. So they're often Canada-wide. They're not particularly great because what they do is they will take your case on contingent, meaning that anything that you receive, so similar to the disability savings plan, you can go back and retroactively collect on taxes for 10 years, and what they'll do is they'll take a very large percentage of it, and the person has no idea how much of a refund they're getting, so they don't really know how much they're signing for. I've seen them as high as 40%, and when you're talking about refunds that could be in the tens of thousands of dollars, it is not a form that would require more than $1,000 to complete. There's no way. But there are people who will help. And certainly even myself, if it's relatively black and white, then I will help an individual. If it's a little more gray and I'm not 100% certain, then I would refer you to the tax professional that I work with. So that kind of is a very quick primer on RDSPs. But before we move on to the next section, are there any questions on RDSPs? Yeah?
I have a question from a previous screen you had there, the rollover.
Yep, the rollovers.
The tax exempt rollover of an RRSP. Yeah.
Yep.
How exactly does that work?
Yeah, so it would have to be contained in your will. So again, there would have to be direction, and then from one financial institution, it wouldn't, rather than closing down the account would then roll over from one financial institution to another. So I would basically, as somebody who manages RDSPs, I would submit a request to have those assets transferred. There are specific provisions that you have to meet in order to do that rollover. So the person with a disability has to be dependent on that individual. So if it's a parent or a grandparent, what they require is shelter, food, dressing. Those are basically the three kind of criteria that are used to determine whether or not there's a dependency. So. Does that answer your question?
No, I've been so interrupted and disturbed here, I didn't hear much of what you said. Basically, what I want to know is that if, when I pass away and I have still an RRSP left over,
correct.
Can I roll that over
Yes.
into his trust or RDSP or anything like that? Or
you can roll it over into an RDSP, yes. So up to that limit, so up to the $200,000 limit, provided you haven't exceeded it, then whatever is left in your RRSP can be rolled over into the RDSP, and so it saves your estate on taxes.
But then that means that untaxed money would be going into the RDSP.
Correct. Yep.
And I don't think the government likes that because they want taxed money coming in there, and then
This is completely legitimate.
The interest part.
No, this is completely legitimate. So it's within the regulations of the RDSP. This is an allowable transfer, and all it's doing is, like in an RRSP, your investment is growing tax sheltered until you withdraw it. Very similarly, in an RDSP, until the money is withdrawn, it's not taxed. So it's grown tax sheltered until it's withdrawn. So the tax burden is going to be significantly less on somebody withdrawing it slowly than it would be if your estate received it and you're basically paying 50% in taxes.
So in other words, if the dependent then takes that RRSP money out, he will pay tax on it as if it was interest earned in the RDSP, but the contributions that were made obviously were taxed money. Those are not.
Everything's separated. Everything is separated at the. So when you're taking money out of an RRSP, it's taxable as income. It's treated in the exact same way when it's taken out of the RDSP. It's treated as income. So you're basically taking money out, and you're going to be taxed on it just as if it were coming out of an RRSP, except it's coming out of an RDSP. So you're just delaying the taxation.
So how do I actually designate that? Do I do it in my will?
Yes.
Do I say that my RRSP
Correct.
residual
Yeah.
will go into the dependents?
That's right. And you would want to let your
RDSP.
exactly, and you would want to let the executor know or the trustee know so that they can execute it. Again, if you have a financial advisor and a lawyer who are all talking, then that can be discussed in advance. But it is something that has to be done in advance of actually. Has to be laid out, yes. Otherwise, the RRSP will be shut down and go to the estate or in order to be dealt with the taxes. Yeah. Okay. Sure. I'm just gonna.
You want to finish?
Yeah. So just one last thing to talk about is the exemptions under ODSP. So this is a big thing that I get asked a lot. Oop. It's a little fussy.
Maybe on the keyboard if you hit the right arrows.
I just don't know where I'm aiming.
Is that it?
No, the next. No, you're going forward.
To the right.
No, you're going next.
Hit the right one.
Yeah. One more.
Yeah.
More.
There you go. So individuals who are on ODSP, many people are aware that there's an asset limit, meaning that there's a certain amount of money that that person with a disability can have before ODSP deems them to be too rich and not needing ODSP. I know, it's hilarious. So ODSP has an asset limit of $40,000. So if a person with a disability has over $40,000 in a bank account, in a GIC, in a mutual fund, in stocks, it will be considered an asset and it will go against their ODSP.
But not a Henson Trust.
Correct. Totally different. So there's also an income limit on ODSP of $200 a month before ODSP starts clawing back on that income. So there are 3 different things that we can use, again, from a strategic standpoint, to set up somebody with a disability in order to be able to access money in different ways. So one of them I talked about is the RDSP. So an RDSP, the entire asset is exempt. It doesn't matter how much money is in there, it is an exempt asset, and withdrawals are not considered income. So under ODSP rules, any money that's taken out can be used and it is not going to count towards income. So an RDSP is great to fund because I always say, you know, this is where you can take out money, they can go on a holiday, they can go buy themselves a gaming system, whatever it is that they want, it's not going to matter what they do with that money. Another option is what's called a segregated fund. So a segregated fund is a very similar investment account to a mutual fund account, but it has additional benefits and it's sold exclusively by insurance companies, so insurance licensed advisors. And under the ODSP rules, you can have up to $100,000 exempt in an insurance product. So because segregated funds are under that insurance umbrella, you can also have up to $100,000 exempt in a segregated fund. The difference between an RDSP and a seg fund is that in a seg fund, while the asset up to $100,000 is exempt, all of the withdrawals are considered income unless they are used for an education or disability-related expense. So again, disability-related expense is a relatively loose term. There's no black and white definition that's going to lay out what what is considered a disability-related expense or not. And so, for example, if you're somebody who requires Velcro shoes or zip-up pullovers only because you have damage to your hands and you're unable to do up buttons or laces, that is a disability-related expense. For you and I, that would not be. And then the last thing, again, is Henson trusts. So a Henson trust, again, there's no limit on the amount of the assets within the trust. So often I would use kind of a combination of whatever is necessary in order to be able to keep that person qualified for ODSP. So even if they don't need the income, even if there's a really big inheritance and they could keep themselves functional from an income standpoint, we all know that ODSP also has health, dental, and vision benefits. And often what happens is if a person receives a lot of money but now loses ODSP and has to pay for all of their health, dental, and vision, that money could be blown pretty quickly. And because we don't know what the needs of a person with a disability are going to be long term, it's better to hold on to as much as possible from an asset standpoint. And then use your benefits through ODSP than to use your own money to do so. So again, the Henson Trust, there's no limit on the amount of assets within the trust. And withdrawals, again, are considered income unless it's for an education or a disability-related expense.
They're considered income by ODSP.
Correct.
Are they considered income by CRA as well?
So yeah, so different kind of income from CRA is correct. They're using it for a tax term. ODSP uses income in an entirely different way. So, yeah. So that's just, again, a very quick overview of ODSP exemptions. But if you, so there, go ahead. Yeah, so that's just my contact information. And then I also have a closed Facebook group where I do share, there's so many different programs and little things here and there that I hear about that I couldn't possibly remember. And so I post them on that Facebook page just so that people can kind of scroll through and find things that might apply to them. So thank you very much, and I will be available for questions as well.